All right, so welcome to the stream today. Really excited for having you. Brand new week. 3 more weeks to go for us in July 2026 examination. And today we're going to be focusing on evaluation of financial statement, looking at the 20 marks area that we are going to be seeing in the exam hall and how that add up together generally at the end of the day. It's going to be an interesting session as we spend the time to look at these areas. So, evaluation of financial statement, 20 marks area waiting for us in the exam hall that we need to understand, and that is in public sector accounting and finance. So, we're going to be going straight up into the discussion, solving some questions, and then addressing some of the challenges that students have in respect of this 20 marks area that we are going to be seeing in the exam hall when it comes to evaluation of financial statement in the public sector environment. So let me bring up my screen quickly and then we can get excited into the discussion. Now, one thing you must understand is that when it comes to evaluation of financial statement in the public sector, there are three models, methods, approaches that can be used to evaluate the performance of entities in the public sector environment. Now, it is important for you to understand that it will depend on the objective of the examiner and which styling of question he wants to bring. And so we can do evaluation using either ratio analysis by calculating the ratios and interpreting the ratios, or number two, using what is called common size analysis, where the financial statement of the entity will be represented in percentages. And so the revenue becomes the base amount for the statement of financial performance, and then the total asset becomes the base amount for the statement of financial position. So we take each line item in the statement of financial performance as a percentage of the total revenue, and then in the statement of financial position, we take each line item as a percentage of the total asset. That is the concept of common size analysis. Then the third approach that can be used to evaluate the performance of an entity will be the issue in respect of budget variance analysis. This is where you are going to be required to prepare a statement of budget performance for the entity for the period under review. Give me a sec. It's like my camera is struggling. Okay. So this is where you're going to prepare the statement of budget performance. To analyze the performance of the entity. So as we go into the exam hall, one of these will be in the exam hall for us to prepare, do, and use that to then analyze the performance of the entity. Each of them have their objectives and what we intend to achieve when they are being used in evaluating the performance of the entity. On the discussion today, we want to focus on the ratio analysis, how we use ratio analysis to evaluate the performance of entities in the public sector, and that is going to be a crucial area. Now, before I get excited into my discussion, let me quickly talk to you a little bit about some of the challenges or weaknesses that the chief examiner has highlighted in the March 2026 examination. Because as I say always, the best way for you to learn and accelerate your progress is to learn from the mistake of your predecessors, people who have gone ahead of you, and then look at the thing that they did that delayed them, that prevented them from moving as fast as possible. You do the opposite, and then you can take your life to the next level. And so for the March 2026 examination, the chief examiner raised a number of concerns when it comes to students' performance. And so I want us to quickly go through some of them and then share our thoughts. Then we can come back and then solve the question that we want to address today. So general weaknesses, the first one is misinterpretation of questions requirements. And this is a classical example of how students end up failing the examination. Misinterpretation of question requirement. So some candidates struggle to fully grasp and respond to the specific demands of the question. For example, candidates were required to explain the importance and limitations of the Nolan principles of public life. However, many simply describe the principles themselves. So understanding the context of the question is very important. And that is the beauty of public sector. Another question was there where students were asked to, in different examination that, for instance, students were asked to talk about the limitations or the objectives of PIFA, but what were they doing? They were rather writing out the pillars used under PIFA. So that's the first thing you want to understand, understanding the context of the question. And if you have followed my work, you know that it is something that I always highlight, that you must understand the context of the question. If not, you are going to be writing a lot of things that will not add any value to you at the end of the day. 2 is inadequate coverage of the syllabus. A significant number of candidates appear to focus narrowly on selected areas. Narrowly. So students were looking at, preparation of financial statement. So you have to cover the entire syllabus. The public sector accounting and finance syllabus has conceptual framework and regulatory framework, has governance in the public sector, has evaluation of financial statement, has preparation of financial statement, has IPSAS coming in. PIFA is there, budgeting is there. So you must make sure that you comprehensively cover the syllabus. Cover the syllabus. Third, weak application of the IPSAS. You must understand that now IPSAS have become integral to the public sector accounting and finance examination, just like how the accounting standards are integral in financial reporting and corporate reporting. So if you are going into the public sector examination, you must be strong on your IPSAS, because we're going to have 20 marks dedicated question on the IPSAS in the exam hall. Then the single entity or the question 1, which is going to be the preparation of financial statement, we are also going to be applying IPSAS in that area. So understanding of the IPSAS will really go a long way in enabling you to actually pass your examination at the end of the day. 4, difficulty in classification under the chart of accounts. That's very important, because if you're in a covered entity, revenue is government decentralized transfers, IGF, non-tax, grants and donations, right? If you're in a central government environment, then you're talking about direct tax, indirect taxes, non-tax revenue, grants and donations. Then the expenditure classification. So you have to be mindful of this. Next one is poor time management. Time has always been a challenge for the examination. And so the strategy is that you're going to put yourself in the position so that when you get to the exam hall, the first thing you do is to read the whole question, and then you start with the written questions that you can do best first. Once you're able to do the written questions that you can answer best first, boom, you are in a better position to now get yourself excited at the end of the day. Another thing is to also adequately prepare for the exam, which is coming up, and I'm going to talk about that. And that is the last point, inadequate preparation. In some cases, candidates' responses reflect minimal preparation and weak grasp of fundamental principle. As we are talking now, it will surprise you that there are people who have registered for the exam and they are not learning. But they are waiting to attend some intervention class be organized by Kwekwanansi, some intervention class be organized by Hey, so that they think attending a 3-hour class, a 6-hour class will help them pass the examination. And I say always, you cannot put yourself in a position and say, I'm going into the exam, I want to pass the examination, but I'm going to use a 4 hours, 6 hours intervention class to pass the exam. Nobody passed the exam with a 4-hour intervention class. 12 weeks, we have not even comprehensively covered everything in the syllabus. And you think an intervention class that you attend 3 hours, 4 hours will help you to pass the examination? What are you on? What crack are you smoking? I don't know. Maybe give me some. And that is one of the key challenges, inadequate preparation. Because people say, they are working, they are busy, they are that. So they register for the exam, but don't prepare adequately to pass the examination. But they will then attend all manner of classes somewhere, thinking that magically a 3-hour class, a 4-hour class somewhere will open your brain and put all the syllabus into your brain in 3 hours and 4 hours. What are you smoking? Like, what exactly are you on? So these are some of the challenges, general weaknesses of candidates that the chief examiner raised concern on. And so if you're going into the exam hall, please be adequately prepared. Cover everything in the syllabus, upwards of 90% of the syllabus. Know the structuring of the question and the expectation of the examiner, how you are supposed to write out your answers. If you can do that, you can put yourself in the position, go into the exam hall, write the exam with confidence, and pass the examination. If not, then you're going to really struggle to pass the exam. So those are some of the concerns that the chief examiner raised in the March 2026 examination. Remember, the average pass rate of the public sector examination is below 30%. Okay? It's below 30%. Below 30%. So it tells you that there is a lot of work that you have to do to enable you to go into the exam or write the exam with confidence and pass the examination. So those are some few things that I want to quickly highlight on before we get excited into our discussion. So we go to question number 4, ICAG, Public Sector, November 2025 past question. ICAG 2025, November 2025, ICAG Public Sector, question 4. And we are going to be using that as a guinea pig and then share our thoughts a little bit on how we can deal with ratio analysis, calculating the ratios, and then interpreting the ratios as well for the entities involved. So let's go. Let's see the requirement. A, it says, compute the following accounting ratios of the two universities. Okay, so it means that the basis of comparison here is two different companies. Two different entities. If we are comparing two different entities, what does that mean? It means that we then have to be careful about the choice of words, because you cannot say, oh, the ratio has increased, the ratio has reduced, the ratio is rising, the ratio is falling, because these are two different entities. Instead, you are going to be using higher, lower, greater, less, perform better, perform worst, that kind of flow in your workflow when it comes to the way you interpret. And we're going to be coming back to that as we go. So let's see what we have here. We are calculating goods and services to total internal generated fund. Government of Ghana grant, that is GOG grant for us in respect of that. Goods and services per capita. So let's just go straight up. Let's see if we have any preambles here. The following information relates to two public universities in Ghana in the year 2024, in the 2024 financial year. Okay. So two universities. So as always, I'm going to present in a certain way. I'm going to have my formulas on one side, then I'll have my solution calculation on another side. Okay. Then I'll have my calculations on another side. So we have Sunyani Technical University and then Bolgatanga Technical University. So Sunyani Technical University, then Bolgatanga Technical University. Okay. So first things first, it says, compute the following accounting ratios for the two universities respectively. I says goods and services to total internally generated fund. Okay. Goods and services to IGF. You write that in full. So that is going to be goods and services divided by IGF times 100. Now, what is this ratio measuring? This ratio is measuring the proportion of the internally generated fund of the university used to finance goods and services. Ideally, you expect this ratio to be lower because it then means that the university will have money available to carry out or finance other activities of the university on the overall. I will come back to that in a moment. So we go to our calculation flow here. So as I mentioned, you got to be careful about the way you write to ensure that you meet the objective of professional presentation. So goods and services, we go to the statement of financial performance, and you can see goods and services here. Quite an interesting figure. 4,085,253. 4,085,253 against 3,237,444. So we divide that by their IGF respectively. And you can see IGF in the revenue segment. And that is 11,610,900. And then 14,427,492. Remember, everything is times 100. So let's see what we got here for each of them. Fastest and 4085 253 divided by 11,610 900 times 100. And I'm getting 35.18%. So the Sunyani Technical University used 35% of its IGF to finance goods and services. Bolgatanga 32,37444 over 14,427,492. And that is 22.44%. All right, 22.44%. Now we'll come back to the interpretation. So let's finish the calculations. The second one is Government of Ghana grant per capita. Now, anytime you hear anything per capita, it means per head. Okay, per capita. Government of Ghana grant per capita. So this is going to be the GOG grant divided by the population of students in each school. So this is looking at the government subventions they are receiving per student head. Now, you expect this ratio to be greater because it then means that the government of Ghana is releasing significant amount of money that should be able to cover each student's need or resources required for the year for them to be able to have quality education. So this ratio is expected to be greater at the end of the day. So Government of Ghana grant, you go to the statement of financial performance, and that's the first item there. So GOG per capita. So let's see, 12,970,100. As against 10,010,000. Divided by the population of students in the school, you can see below there, note 150,000 for the Sinyani, and then 136,000 for Bolgataga. Now here, the answer will be in Ghana city per person or per student, right? So let's see. Now you got to be careful because sometimes you see this figure, we are not working in it 3 zeros up or million or whatever. You know, I always emphasized on this because that means that in the footnote, it will change what kind of value you are going to be using in the presentation. So let's see. 12,970,100 divided by 150,000. And that is 86 point maybe 47. 86 Ghana cedis. 4, maybe 5. No, 47 rather. Per person. Okay. or per student, whatever. It's a school, so we can say per person or per student. Then the second one for Techiman, is it Techiman? Bolgatanga rather. 10 and 10, 1, 2, 3, divided by 160,000. And that is 62 Ghana cedis, 56 pesos per student. So you could see that government subventions, government grants to the school is significantly high for both universities, although we are seeing Sunyani Technical University having a higher amount of grants per student in respect of that. Now, largely you will see that they have, no, I made a mistake. This is 136, not 160. So let me punch that again. 136. Okay, so 73.60 rather. $73.60. Okay. Yeah, so Sunyani is still having a greater percentage of amount of money they've gotten from the government of Ghana per student than Bolgatanga. Again, we'll come back to the interpretation flow. Goods and services per capita. Now, goods and services per capita, what is it looking like? Now, remember, goods and services relates to the day-to-day running of the university, right? So goods and services per capita has to do with the amount the university spend on each student for the year ended under review. Now, technically, you expect this ratio to be greater because it means that students will have quality tuition, they will have the materials they need, the resources they require. But if this ratio is significantly lower, it will mean that there will be lower quality of education provision. Lecturers will not have resources available. Like some universities in this country where lectures can be cancelled because there is no generator to turn on a PowerPoint. So because PowerPoints cannot be used, the lectures for that day will be cancelled by the lecturer. And some other, sometimes you think about it, illogical, immaterial, useless reason for canceling lectures in some of our universities in this country. And this is where sometimes you would think SRC should step in and be responsible. But again, in many of our universities in this country, the only purpose of the SRC is to organize big events, which artists is coming, entertainment, having fun, and student security, student health, they don't care about it. It's unfortunate, but that's where we are. But that's the idea about goods and services per capita. What the student is spending per head. Sorry, what the tuition the school is spending per head. And you expect this ratio to be significantly higher. So 1, 2, 3. Goods and services per capita. And so certainly, now you got to write the formulas down, okay? Because some of you think you can run away over population. The formulas must be written down. You cannot just jump and say, oh, I'm in a hurry, I'm going to write. No. You're not in a hurry. The formulas are part of the solution. Okay. So goods and services, let's go back up. Okay, we've used goods and services earlier. So permit me to see if I can copy them. Paste. There we go. So we divide that by the population, which was 150,000 for Sunyani, 136 for Techiman. So let's see how much is being spent here. 4,085,253 divided by 150,000. And that is 27.24 Ghana cedi per student. okay, per student. 3,237,444 divided by 136,000. And that is 23 point maybe 80 per student. Okay, or per person. So in the case, in what we have here, the universities, you could see that Sunyani is spending more per student head than Bolgatanga, which simply means that students at Sunyani Technical University are likely to have a much quality education experience than students at Bolgatanga University. But another way we could really look at this is if there is any industry or national benchmark. So, for instance, if there is a benchmark that the goods and services per capita should be maybe 50 Ghana cedis or 100 Ghana cedis, then that can be a threshold we use to then measure whether the universities are doing well. But on the face of this, Sunyani Technical University is having a higher goods and services per capita. So the amount of money they are spending per the number of students they have, it's higher than Bolgatanga, which means that on the average, students in the Sunyani Technical Universities will have better, much quality education than students in the Bolgatanga University. That's the idea about that. And that was what I was saying earlier in respect of how some of the things are done in this country. Like tuitions are cancelled because there is no light, there is no generator to turn on a projector. And because there is no projection, the lecturer cannot teach. Everybody go home. How can you in 2026, a whole university has a department, they cancel tuition because there is no generator to turn on a projector, and so tuition is cancelled in 2026? It's so ridiculous. But RSRC will not look at some of these things, though. They won't look. It's about, hey, let's organize party. Hey, let's bring this artist. Hey, and in same. That's all. That's all. Next, productivity ratio. That is revenue to expenditure. So productivity ratio. So we are looking at a percentage of total revenue that was used to, that the entity spent on total expenditures in respect of that. So revenue to expenditure. Now, normally this will be in times. So you are looking at how many times your expenditures can go into your revenue. All right. Other times, it could also be measured in percentages. So that's an alternative presentation where it could be measured in percentages. If it is measured in percentages, what is happening there is that it means we are looking at the percentage of the revenue that was used to finance expenditures generally. Okay, generally. So it can be in times or in percentages. So let's see. Productivity ratio. So total revenue of each of them, 27,798,500. And then total revenue here, 27,504,320. We divide by total expenditures respectively, we can see 14,671,753. 14,671,753. As against 12,636,368. So let's see what we got here for ourselves. 27,798,500 divided by 14,671,753. 671,753, maybe 1.9 times. Okay. And then for Bolgatanga, 27,504,320 divided by 12, 636,368. And that is 2.18 possibly. So if you look at the two entities on a productivity level, I mean, they're all on the overall could be considered doing well because they are doing, you can see their surplus here, and you can see Bolgatanga has a higher surplus than Sunyani University. And so the revenue of Bolgatanga can cover its expenditures 2.1 times. That's a significant thing. It means they will have a lot of surplus available that they can reinvest. But again, we have to be careful about the surplus. Because if the university or the institution becomes more profit-oriented, then they are going to sabotage other activities. You get the idea? Because if the university doesn't spend more money on students, providing them with the services that they need, like the example I was giving, lectures are being cancelled. Lectures are being cancelled because there is no light in this day and age for projection, when the university is supposed to provide that. And so if a university is reporting huge amount of surplus and the people are satisfied, then we need to ask ourselves, how are you recording surplus when quality of education or quality of tuition, lectures are being cancelled because there are no resources available? Why? So it's a good thing for them to have a higher ratio on productivity. But we have to also look at the nuance on that side to make sure that when this is too high, we have to assess the quality of education, quality of services, administrative work that the entity is providing to students' activity generally. But on the face value here, Bolgatanga seems to be more productive than Sunyani Technical University because certainly they have a higher productivity ratio than Sunyani. Next one, quick ratio. You know quick ratio from KG2. All right, this is liquidity. Okay, quick ratio. So this is going to be assessing liquidity. So that's going to be current assets minus inventory divided by current liabilities. So let's see what we got here. In this place, I have to go to the next slide. Number 5. So quick ratio, current asset, current asset, current asset. Current asset is 14,633. Sorry, 14,633,000 for current assets. No. That's receivables. You got to be careful about the figures I'm picking. 31,057,320 and 57,310. And then we have 23 million. At this state, my write-up will not go there. 908,176 because I need to do subtraction. So permit me, I will have to restructure this like this. Like that. So inventory is 7,159,500. 7,159,500. Then inventory for this 54,58,689. So divided by current liabilities. Current liabilities. You can see current liabilities here. 16,286,000 844, and then 11,474 and 24. Sounds good? So let's punch that out, quick ratio. Now, you know what quick ratio is measuring? The ability of the entity to pay short-term debt as they fall due. So the liquidity position of the entity, certainly. That's what is being measured here. So what do we have? 31 and 57, 310 minus 71,595 divided by 16,286,844. And that is 1.4, maybe 7 times. That's above 1 because you know the threshold is above 1. So above 1, I mean, it could be considered good. Bolgatanga 23,908, 176 minus 54,586,89 divided by 11,474 and 24. And that is 1.61. So from a quick ratio perspective, it appears that both of them are liquid. They can pay their short-term debt as they fall due. Although Bolgatanga's ratio is marginally higher than Sunyani's ratio. So that's our quick ratio there, assessing the ability of the entities or the universities to pay their short-term debt as they fall due. The next one is cash ratio. The cash ratio is like the quick ratio Pro Max. So the cash ratio is looking at your cash and cash equivalent with your current liability. So if you are supposed to really pay your debt and your debts are due to be paid, what can you get? What can you convert into cash within the shortest possible time? And so that's going to be cash and cash equivalent divided by current liabilities. Okay, cash and cash equivalent divided by the current liabilities. So cash and cash equivalent, you can see in the current asset here, we have cash and cash equivalent. And so 9,264,810. $9,264,810 as against 7,294,233. We divide that by the current liabilities. We used that a moment ago here. So let me just copy. Then you paste. So we punch this out. Again, this is assessing, as I said, the true liquidity position of the entity. So if we look at the entity's position, can they pay their short-term debt as they fall due? So this is assessing the true liquidity position of the entity in question. So 9,264,810 divided by 16,286,844. That's 0.57 times. That's not good. That's below 1. So that's not good at all. For Bolgatanga, 7,294,233 divided by 11,474 and 24. That's 0.64 times. So when it comes to cash and cash equivalent available to be able to settle, so if just tomorrow the creditors come, okay, the suppliers come because the creditors here are payables. So if those payables become due tomorrow or in a week's time, both entities cannot pay because their cash and cash equivalents they have is far less than their current liabilities. Although, again, you are seeing that Uh, the Bolgatanga University's ratio is just marginally high, but the both of them are just in their sync. They are not going anywhere. Are you getting it? They are not going anywhere. So that is the idea about a cash ratio. Then we come to internally generated fund to capital expenditure. So here we are looking at the percentage of the internally generated fund that went into capital expenditures. So VII, internally generated fund to CapEx. That's going to be internally generated fund over capital expenditure. Now, I want you to stay with me carefully here. So, if we come back VII, IGF to CapEx, internally generated fund, I think we used it somewhere earlier. Yeah, we used IGF in the note 1, in the calculation 1. So permit me to copy that and bring them in here. Now we need a capital expenditure. Now there are ways that the capital expenditure can be calculated. If we check carefully, you'll see that note 2 here says property, plant, and equipment balances of Bolgatanga Technical University and Sunyani Technical University at the carrying amount at the beginning of 2024 were this and that, respectively. Now, so because in this question we've been given the opening carrying amount of assets, then we have closing carrying amount as well of the property, plant, and equipment here. So it means we have to be able to calculate what the CapEx. Okay, so that closing figure was arrived at after they charge consumption of fixed assets for the year. Okay, after they charge consumption of fixed assets for the year. And so we're going to be adding that back and then subtract it from the assets from the beginning, and then boom, we can get our capital expenditure for the year under review. That's one school of thought. Another school of thought will say that, okay, the depreciation would have been charged on the opening figures as well as assets acquired during the year. And so for that reason, if we want capital expenditure, let's just subtract the carrying amount from the beginning of the year and the carrying amount from the end of the year. These are the two schools of thought of the computations when it comes to dealing with the capital expenditure. Now, assuming the note 2 was not there, if the note 2 was not there, then our capital expenditure would have been calculated by looking at the things under non-current assets. So probably all these figures here would have been considered as what? Capital expenditures. And that's something I want you to be mindful of, including equity investments. Because in the public sector, equity investments are considered capital investment. Why? Because of the fact that in the public sector, we see them as giving us future economic benefit. So if the government of Ghana invests in a bond or buys some shares in a company, it's a capital expenditure because future economic benefit in the form of dividend or interest will flow to us. So it depends on the styling of the question and the way you work yourself out generally at the end of the day. In the context of this question, because we have the opening figures available, the opening carrying amount available, we can simply subtract that from the closing carrying amount figures available, and that should give us the capital expenditures. As I said, another school of thought would have presented this way that we bring the balance brought down, which is the current year's closing figure. Then you add back the consumption of fixed asset. For the period. Then you can less the balance brought forward, which is the opening figure of the capital expenditures. So that opening figure of the PPE, so that we can now get a capex for the period under review. Now, the limitation on this approach is that it means the capital expenditure figure we are calculating or arriving at is devoid of depreciation that has been calculated during the year. So this approach or formula is a little misleading, because we are not considering, in that case, consumption of fixed assets during the year. And we are thinking that any increase in the property, plant, and equipment is because of capital expenditure. So that is a bit misleading. That is why, in another school of thought, we will not bring the effect of the capex. All we will do is we will bring in the carrying amounts. The carrying amounts at the beginning of the year, carrying amount at the end of the year. What is the difference? The difference of that will be considered as capital expenditure. That is again misleading, because the fact that PPE is going up doesn't mean during the year the entity acquired any assets. They could revalue assets, and there will be upward revaluation of assets, right? And if there is upward revaluation of assets, your PPE will go up. So although PPE is going up, it doesn't mean the university or the institution acquire assets during the year. What am I trying to say? All I'm saying is that all these methods or approaches have some limitations in them, and you have to understand what you need to understand based on the context of the question. So we can just stay with the opening and closing balances and then deem that to be capital employed for the period under review. Did I say capital employed? Deem that to be capital expenditure for the period under review. So capex, permit me to work that somewhere quickly and then bring me up here. So we bring the closing figure at the end of the year. And that is going to give us 11 million 900 and property, plant, and equipment for us in respect of that. 11,976,100. Is it 9 or 7? Yeah. 976,100. As against 10,028,000. Then you less the opening figure, which was given in the notes. Bolgatanga is the first figure. Sunyani is the second figure, so you got to be careful. 7,600,000. And then Bolgatanga will be 9,200,000. Again, in the context of this question, we are not going to be canceling any zeros because, we're just working and working. So we do it, and there is going to be capex. Now, you don't have to comprehensively work this out. You could have just worked it out below here. I don't have a space. That's why I'm trying to work this out separately. So 11,976,100 minus 7,600,123. And that is 4 million for us. 4,376,100. Please stay with me. Bolgatanga, Sunyani are this and this respectively. Yeah, so the 9 million is for Bolgatanga, 7 million is for Sunyani. Yeah, let's go. 10 and 28,000 minus 9,200. 1, 2, 3. And that is 828,000 for us. So we take these out. And come back here and work ourselves out. So what do we have? How many times is, again, this can be represented in times, also in percentages, right? So if we are doing in times, then how many times is the total IGF covering capex? Or what's the percentage of IGF that is going into CapEx? So 11, 610, 900 divided by 4376 100, 2.665, 14, 427 492 divided by 828 123, 1742 here. So if you check, Sunyani is having its IGF covering its total expenditures by just 2.6 times, whilst our people at the Bolgatanga 17. That's quite high in respect of that compared to their capital expenditures, which means that Sunyani University may be investing more in capital expenditures than Bolgatanga University. And some reasons could be attributed to that. It means that they may be investing into, infrastructure, right? Equipment that students need in order to ease or aid them in their tuition, in their work. But then Bolgatanga may not be doing much of that. So that's why they have a huge IGF, but just less capital expenditure for the period under review. Then the last one is debt to total asset. This is like gearing in the public sector. So debt to total asset. So that's going to be VII. So debt to total asset. And that's going to be the interest-bearing debt over total asset. Times 100. So you are looking at the percentage of the total assets of the entity financed by debt. So it's like gearing, long-term solvency. So this one is assessing the long-term solvency of the universities. Remember, in the short term, they are having problem, right? Because if you check their cash ratio, it wasn't good, but their quick ratio was above 1. Their cash ratio wasn't good. So VII. Okay. There we go. So let's get the debts. Go to the statement of financial position. Look at the debt. You can see bank loan there. You are using not total debt or interest-bearing debt because this is like gearing in the public sector. So interest-bearing debt. So that is 28,820,000. 28,820,000 for Bolgatang for Sunyani. No, 850 rather, Nhyira. Then 22,508,600. So we divide that by the total assets. Total assets, you can see total asset here, 89,151,410. 89,151,410. 72, 464, 176. So we punch it out. 28,850,123 divided by 89,151,410 times 100. That's like 32.36%. Okay, 32.36. 22,508,600 divided by 72,646,176. That's like 30, maybe 31%, approximately. So if you check, the two entities are not highly yet, because if you look at it, only 30, just a little over 30% of their total assets are financed through debt finance. It means the rest of the assets are financed through themselves other than debt, which is a good thing. So the two universities are not yet. Okay, they can raise additional debt finance in the future if they want to. And these are the things we must understand on the A part of the question, calculating these ratios. And so you see that the calculation here is 12 marks. Now remember, if you screw up the calculations, then au revoir mon ami on the analysis for you. And so we will just put together a quick summary. Now, you don't have to do this, but you would want to do this to help you not to be flipping through your scripts. So you'd want to do this to have the ratios at a glance, right? So you can see them and then reach a conclusion and write your analysis. Because as I say always, if you're writing the analysis and the analysis is not structured well, then you may be making one statement at the expense of another. Like you may be contradicting yourself in the same ratio. So having it at a glance like this helps you to have an understanding of exactly what is going on for the period under review. So let me bring up all of the ratios we calculated. I don't know if I can do that though, but I'm gonna try. It's not gonna work, Nhyira. Because undo. Oh God, undo. That's too much. Give me a sec. I need to just let them close up a little bit. As I said, this is not compulsory to do, right? You can decide not to do it. You just want to have things at a glance. So IGF to CAPEX. So I can now copy these guys and send them to the summary thing that I'm preparing here. Don't worry, I'm going to make it a little smaller. Okay, something like that. You get it. Then the last one was what? Debt to GDP. Debt to total assets. At this point, I need to take this key summary probably to the next slide to allow me with real estate to work. So, boom, we go. So let's bring the ratios up and then we interpret. Okay, let's bring the ratios up. Now, if you want more questions like this, getting access to questions solved and discussed like this, then our practice question courses will really be helpful for you. So we have the practice question course for financial management, public sector accounting and finance, advanced audit and assurance, management accounting, financial reporting, corporate reporting available. Now, when you enroll, this gives you access to the questions and the answers. Then you will be able to get the videos solving, like what we are doing right now, explaining how these questions are and how you solve them. And questions are pulled from various angles. So we have ACCA questions, ICAG questions, SEMA questions, right? So from various angles, based on the syllabus structuring, so you have an understanding of how principles are applied in various circumstances under various environments. So if you want more content like this, getting access to premium content that will help you, then certainly visit our website. The first link under this video in the description, NhyiraPremium.com, or you can download the Nhyira Premium mobile application and enroll in the practice question courses. Get access to these, and your enrollment also gives you the opportunity to join our Executive Vision Masterclass. And that is going to be helpful to help you polish you up well so you can go to the exam and pass the examination. Certainly, if you have any other questions that you would want to ask, you can send us a message on WhatsApp 05011499296. You can see the number below your screen, or head on directly to our website and you will be able to enroll in these courses so that you can put yourself in the position, prepare adequately, and ultimately pass the examination. Okay, so check it out on our website. So let's clean up everything now. If I want to bring these ratios, copy. See that it's a lot of work, but it's necessary. Then these guys, make it smaller. That is per capita. Number 3, okay. All right. Number 4, productivity. There we go. Number 5, quick ratio. Number 6, number 7, there we go. So you see that at a glance, you can have everything at a glance, then you can write your analysis. Finally, the B part says write a report. Okay, write a report on the performance of the two universities under financial performance, short-term liquidity, and long-term solvency, because you need to understand the categorization. Okay, the long-term solvency. So these guys to this place, from 1 to 4 financial performance, quick ratio and current ratio is going to give you the short-term liquidity. Then the long-term solvency will be the last two. So that will be the heading. Now, this is a report. So pro forma of a report is going to be crucial. We are writing a report to whom? We don't really know who we are writing the report to, but you can come up with something. To whom? From whom? You are not giving a title as well, so you can give yourself a title. Subject. Then the date. You can write the day on which you are writing the exam, 13th June 2024. Subject. Analysis of the performance of two universities. Then your introduction will come. Your introduction to tell us about the objective of the analysis, and at this point you know how to write these things because we've discussed them already, so you know how to write these things. Now, so to whom will you be writing? You're analyzing two universities' performance. You are not giving anybody to write to, but it's a report. So you can say maybe the Ministry of Education or the Ghana Education Service, whatever. Or it could be an SO, a CSO, okay, a civil service organization. So Ministry of Education or Ghana Education Service. You can say ICAG level 2 student. Okay. Subject matter. performance evaluation. Of 2 universities, right? Then you have your introduction. After your introduction, you write, you now start with financial performance. So that will come as a heading. When you finish, you come to liquidity, okay, which is short-term liquidity, and then you go to the long-term solvency. So under these headings, you're going to be explaining these ratios. Then you come to the conclusion paragraph, which you are going to be talking about the overall performance of the universities, and then you make specific recommendations on what you think they must do going into the future. And the recommendations, as you know already, has to be specific recommendation, not generic recommendations. Then you have your closure coming in. Thank you. Yours sincerely, signature, your name, and that is it. So pro forma is going to be crucial. Then you come to the analysis write-up the way we have discussed it. And this is what you must understand. This is 20 marks, November 2024 ICAG examination. And you can see that there is nothing miraculous here. Right? There is nothing miraculous here. But as I said, if you screw up the calculation, then your analysis is going to be au revoir, mon ami, because your analysis is premised on the outcome of the calculation. And that is something you need to be mindful of when you are looking at these discussions generally at the end of the day. And so that is what you must understand when it comes to evaluation of financial statement. And that is where I'm going to be wrapping up our discussion for today here, looking at this 20 marks area. Remember, as I mentioned, in this question 4 area, public sector evaluation of financial statement, there are 3 methods, approaches available. We can use ratios, we can use common size, we can use statement of budget performance or budget variance analysis. One of them will be in the exam hall as you are going into the exam. And in the next session or in another session, we're going to be looking at some other questions where common size is coming in or budget variance is coming in. So you see how each of these can be prepared, and most importantly, how we write out our analysis at the end of the day. And these are the things that you must understand in respect of that. So that is it about that. And thanks for joining us on the stream. Thanks for the thumbs up. Thanks for liking. If you have any questions, please leave them in the comment section, or you can send us a message on WhatsApp. You can see the number scrolling below the screen, 050-114-9296. 050-114-9296. Remember to download the Nhyira Premium mobile application or visit our website so you can enroll in our practice question courses and get access to some of these exclusive content to help you adequately prepare for the examination so you can pass the exam. Have a great week, and I'll see you on the next one. Make sure you stay connected so that when we go live, you'll get a notification to be able to join. Take care of yourself.